which I think we need to understand and debate. Vikash Jain joins now, represents CLSA. Let's take our conversation forward. CLSA of late has been advising their clients that look, India is a great story, but valuations do not support the near-term risk-reward ratio, and I guess that is one of the reasons why FIs have also started selling, because relatively India is good but no longer attractive. Vikash, good morning. Thank you for joining us. We've been on the wrong side of FI selling. We've been on the wrong side of Paytm listing. Suddenly, for a market where everybody thought nothing could go wrong, we are slipping a bit.
Good morning. Thanks for having me. Yes, so to some extent, that's how markets work, don't they? So essentially, if you think about it, and this is something that we wrote about in my report in sometime in early September, where the title was Overstretched, where one of the things that we noticed was we had this proprietary India Bull Bear Index, which was flashing red. I mean, it was almost signaling a 98, 99% bullish reading. And we thought that there was time for perhaps market to cool off. And this was just when we were going into the Fed meeting. And if you think about it, the quarter ended September, we've had almost India outperformed, say, the US by nearly 10 percentage points or more. And now, if you think about it, in this quarter to date, India has underperformed by roughly similar number, little lesser. So in a way, that big last quarter euphoria that we saw, which was more India specific, where globally, if you think about it, we were in a little bit of a growth scare. If you look at all the various things which were happening, commodities were coming off. It was primarily India-led. So there's been some mean reversion to that, is the way I would want to think about it more than anything else.
Sequence of events which now will be watched out for the market. What could be the trigger? Earnings, budget, inflation. What is that moving part now?
So I think the big moving part is, so this is something which even our note, which we have come out with today, which talks about our takeaways from our recently concluded India Forum. What we figure out is when talking to companies, everybody seems to be confident of or have given a reasonably positive commentary on demand. However, our opinion is that this might be colored by the fact that over the last 2-3 months, say the period from September, October, November, we have possibly seen some bunched up of demand, in the sense that some opening up revenge demand as well as festive demand kind of put together. So how much of this is sustainable or not is really the big question. I think the answer to that question is something which we are likely to get by sometime around January or so, when numbers beyond the festive season, that is going into December numbers, January numbers start coming in. So early part of next year is when we start getting answers to that. I think that's the most important thing, because we are perhaps then in what would be called a post-COVID economy. If we are in a post-COVID economy, how does that economy looks like? What we should not be forgetting is this phenomenal 18-month or more than 18-month long bull market that we've seen starting right from March 20 was started from action being taken by central banks as well as governments, where the popular thesis which started panning out was because of these actions, demand would sustain and we would have a pretty strong post-COVID economy globally. Now that argument has so far not been tested, because everything which we saw was shrugged off by the market as one-off, impacted by COVID, this wave, lockdown, etc., etc. Unless we have a third wave, COVID stops being a pretext. If COVID stops being a pretext, we truly start being able to see, for us to see how a post-COVID economy looks like. And the other thing also to note is, so far, even when we make comparisons to 2019, say September, October 2019, and say that, data is so much up or down. But what we have forgotten is the last part of, or the second half of 2019 was a very weak period for the economy itself. Things only started picking up around January and February 2020. And if you remember, the finance minister had come and done a big tax cut around September, October 2019. So because economy was relatively slow. So I think that base also gives way. So once we get into December, January, February, and these high frequency economic numbers as well as company numbers would definitely start mattering. And that's really the big thing, because that decides whether we continue with our EPS upgrade cycle or not, or, which is, we've seen very limited downgrades over the last few quarters. That's a welcome change from, almost given downgrades that we used to see after every quarterly results over the last 10 years. So I think, is that changed for good or not? So it's more to do with, I think, current valuations of the market is symptomatic of very high, or suggestive of very high expectations. And those expectations will be tested when we start seeing this period from December, January, February. Coming back to our conference itself, the other thing which companies mentioned is a lot of them have perhaps taken confidence from this demand and are thinking of or have raised prices post the festive demand, or have been raising prices to pass on the inflation worries or the cost inflation that they have seen. Now that also gets tested, whether that demand was real and whether it will stick on even at higher prices also gets tested. So I think there's a lot of that stake, because from December onwards, we can no more take the pretext of COVID. So it's going to be a reality check, which the market has not seen for the last 18 to 20 months now.
I mean, the points which you've just tabled, I think they are natural and they are obvious. But typically when earnings starts after years and years of drought, it's not going to be a 1 year phenomenon, it will not be a 2 year phenomenon, because the word animal spirits, which was missing pre-COVID, is now back. Optimism is there. The landscape is very different. So while all the points which you mentioned, they need to be examined, they need to be reviewed, but somewhere if I look at the history of earning cycles, do you think we are in for more of a surprise, more of earning beat rather than normalization, which some think that could be a sugar rush COVID phenomenon?
So in a way, what you're saying is trying to bring the economic picture and comparing with the stock markets. We need to be very careful when we do that. So firstly, maybe that nothing disastrous is going to happen to the economy. I mean, however, when we are talking about that, we need to take into account one very big factor, which is the key to stock price movement, which is expectations. So how are we placed versus expectations is what will define how stock prices move. And on that bit, the simple thing that I'd like to kind of bring to picture again is to the fact that we might not see a significant slowdown or an economy or a recession that we are talking about. But the fact could be that the pickup that the market is baking in may be much slower than what is expected. If that happens, see, any disappointment that happens at very elevated valuations could lead to exaggerated impacts on the other side. And that's something that we need to take cognizance of. So a lot of times stock markets can correct. Like, for example, if you remember, post the rally that we saw from 2009 to 2011, there was still a reasonable correction in the stock market, and that was not really baked from any big recession that came in, but simply because of, expectations had rallied. And then there was a reality check, which said that maybe things will not improve so fast, so quickly. So I think that's a phenomenon that one needs to bear in mind. Of course, there are other factors as well. For example, how would equities look in comparison to debt as yields start going up? That's something which will be a global question mark, which we have to say. So maybe the relative attractiveness of equities will be lesser, and expectations could be, found to have some reality check. So those are two things that we need to take cognizance of, and the answer to that will determine the side that we take. But we need to keep in mind that we are at very elevated expectations. So we should not just close our eyes and say that, yeah, we are in the early phases of an economic recovery, so this should last longer. Yes, you might be correct about the economy, but that doesn't mean that, I think historically watching the economy and investing in stocks has not led to great results. And that's something that we need to bear in mind, because expectations is a very important part when it comes to investing in stocks.
And we've all started getting used to that straight line rally with, hardly any mini corrections also. Good morning, Vikash. This is Nantara. So, you did recently host many of your clients. That's what we understand. What is the feedback that you are getting from your clients when it comes to India, which has been such a large outperformer, at a time, and you've alluded to some of this, when the Fed is tilting towards becoming more hawkish? If you look at the US dollar index also, we've started already to see the FII sell out in the last couple of sessions. Is flight of capital something we need to start talking a lot more about? What is the kind of feedback you're getting from your foreign clients?
So I think on that, again, coming back to that report that I talked about, the one factor that we mentioned in that September report called overstretched was India's India was overstretched not just on the sentiment index just by itself, but if I were to look at certain other factors like momentum of the market, like valuation relative to the EM or the Asia X benchmarks, all of them were looking very stretched. And that is something, if you think about it, the rally that we have seen in the dollar index over the last 6-8 months from the lows, that's something which anyways has made emerging markets less attractive. Now, within emerging markets, and plus whatever was happening in China, had made emerging markets as a basket less attractive. Now, within that, if we find India as as very expensive, then that's something which is the other worry. What we have to kind of go back and think about it, what was happening through July to September, which really allowed our markets to do much better, and it was more an India-driven rally than anything big happening globally, was a few things on which India was looking significantly better than other markets. Number one, unlike many of our Asia peers or EM peers, our second wave had peaked sometime in early May. So there was continuous decline in COVID cases, which was happening. There was gradual reopening, which was happening, which made us look much better on a relative basis. There was incremental regulatory concerns in China, which made India again look much better on that perspective. And within, so all of those things, along with the fact that the commentary from a perspective of stance being taken by the government, or the general perception of Indian government, also helped the markets. But a lot of that might be unraveling. I mean, people are now asking questions whether valuations in China are now possibly become attractive enough that they are pricing in the risks that people are fearing about. There is a general tendency that we have seen, of laggards to do well in the last quarter, which has also impacted Indian markets, in my opinion. And the other thing is the vaccination, as well as the COVID situation in many of the other peers that we have, is looking much better than what it was looking in the July to September quarter. So from that perspective, yes, you're right that people who are from a more shorter term perspective, yes, clients are not really jumping to buy India at this juncture in terms of foreign clients. But what we need to not forget is that we are perhaps this fiscal, maybe another fiscal, and in the last 6-7 years, I think there's been almost 4 or 5 fiscals where Indian domestic investors have put in more money than foreigners, if I were to look at fiscal years. And that's the other thing that we may not, which we should not even forget. So if FII selling just abates, then and domestic buying continues, that itself could be a reasonable point. But, I have to concede that foreigners are not really queuing up to buy India like they were doing, say at the start of the year or something like that.
Okay, so they're not chewing up to buy as they were the India story earlier. So tell us, where is it that they are buying? You were also making a case that the laggards are paying a catch-up. We'll get to financials in a bit, but we started to see that with autos, for example. Autos have started becoming hot again, maybe because of the entire EV play, the companies like Tata Power, Tata Motors, etc.
Sure. So I think, again, to look at autos, we need to divide the space into 2-3 different parts. First,
I think we just lost our connection with Vikash Jain of CLSA. He will be joining us very soon. He was just talking to us as far as the auto sector goes. Just a quick checkup on how the markets. Oh, I believe Vikash is back with us. Vikash, you were talking to us about the auto play.
Sure. So on autos, the one thing we need to kind of divide the sectors into sub parts, and each one of them have their own drivers in the way the market is perceiving them. For example, there's this two-wheeler bit where there is this worry around disruption, which I think could pretty much sustain, and that's where one needs to be a little bit more careful from a top-down perspective. There is the four-wheeler segment where the immediate disruption worries are a little lesser. And thirdly, there is the other bit where, commodity prices, or the thing that commodity prices could come off because of the kind of demand worries that we are seeing in China, is the other tailwind that people are talking about. However, the overarching thing that one has to keep in mind is we are still not 100% sure of how strong demand will be and how quickly the supply chain worries could get sorted out. So those are certain factors that one needs to ponder about. But broadly, the way we have to think about it from a top-down perspective, unless, of course, one is welcome to take a bottom-up view and say that, value might have started coming in some of the stocks. But two-wheeler doesn't look like a great place. There could be a couple of very disruptive launches that could happen, or supplies, on the market, which could keep the worries high over there. Within four-wheelers, I think it's more about the demand, but there are other segments like CVs, tractors, etc., where perhaps the metal prices coming off could have a slightly bigger positive impact as compared to the others, and also the demand concerns are lesser. So, from that perspective, that's the kind of space that we'd like to be. Of course, some of the, we do have more bottom-up picks, a couple of bottom-up picks in our portfolio for auto, that is to do with the tractor name as well as the name that you mentioned. And they've been doing okay in this particular quarter.
Nayantara, do it not look so?
Okay, Vikash, that's all the time we have for today. The next time we have you, we'll ask you about your first love in the stock market, which is oil and gas. There's a lot that's happening on that space as well. Thanks a lot for your time today. We'll take a